Hi, welcome to Numerics Video Blog, your expert source for derivative trends and topics. I'm your host, Jim Jockel. As we continue to follow the issue and impact of the global negative rate environment, an interesting article was recently published in The Telegraph, and has brought to light some interesting questions and some fairly startling facts. Here to discuss this is Udi Sella, resident trading strategist and FX expert for Numerics. Welcome, Udi. How are you?
Very well, thank you, Jim.
Thank you for joining us. In this story, Jeremy Warner of The Telegraph states that negative interest rates have put the world on course for the biggest mass default in history. And while this is a huge assertion, I wanted to start with you, Udi. And do you agree or disagree with the reporting from Jeremy Warner here?
Actually, in terms of the biggest default, I personally don't see that. What may happen is inflation. Because basically what is happening is that the central banks, the large ones, if it is the US, the Federal Reserve or the Japanese bank, the Chinese or the European Central Bank are flooding the market with cash. So eventually, it's in order to kind of try to sustain demand and of course lower funding. And so eventually I think this money will hit and will create inflation. And if you like, Jim, what we've been seeing in the last 2 weeks is actually a reversal in the respect that, the yields are coming back from, the extremely low levels. If we saw, the bonds from the 10-year bond from hitting zero is now trading at something like 75 basis points, still very low, of course. And even the Swiss 10-year note is trading above zero. The one thing that you will see is people are being afraid of the liquidity trap, and therefore people are now exiting the trade.
So that brings up a question, right? So, we've seen the sharp decline in the Bund and obviously what's going on in Switzerland. Are we more poised for continuous shocks like this as liquidity concerns continue to plague the market?
I think that's a great question. In my opinion, yes. I think that the volatility will rise even further. And again, the thing is, given the latest regulation, what is happening is that people do not want to hold large positions. So it's very difficult to get, in this case, bids. Enabling people to sell bonds for large amounts. So this is creating a lot of nervousness in the markets, which of course means higher volatility. Yes.
So that begs the question, though. With the negative rate environment, where are investors going for yield?
So I personally think, we're seeing a couple of things. First of all, we're starting to see a recovery in commodity prices. For instance, copper, or of course oil. In crude oil, we see that in WTI, we see that in Brent prices. I think that we may see now. I think that smart money will go into inflation-linked bonds. We see a little interest in credit structures, and interestingly, because the recovery, although unemployment is coming lower in the U.S. still, it is not followed by salary increases. As a result, the inflationary pressures are not that high, and people are moving away from bonds, from U.S. bonds. And as a result, the dollar has weakened a bit from the low levels, let's say 104 against the euro, trading now at 112.
Where is the end in sight here? Is it a pullback in quantitative easing? At what point do we potentially see some sort of normalization?
People now are talking even, 2018, 2019, when previously speaking of 2016. So, and to some extent, people even are talking about a new order of low rates. So the new normal could be instead, rates of 2% instead of 4%, which seems to make sense to me, because if you look at the overall growth of the economy, we moved down from levels of like 4 or 5%, and the new normal seems to be like around 2 to 3%. Depends if how emerging the economy is in which country. So perhaps the new normal, we should forget about the past, and the new normal is rates which are much lower. And if you even look at, even works that economists won the Nobel Prizes for, so if the problem of the 70s was inflation and then stagflation, it seems now that the problem is really this environment with weaker demands and weaker growth.
So for final thoughts, what are you watching? Any particular indicators? Is it oil? Is it looking at a geopolitical landscape with the current UK elections? What's keeping you up at night?
I look mostly at the 10-year yields, and I look at commodities, and I also try to look at credit spreads to see how, if you like, how distressed the market is. But if I always want to see where the market is going, the first thing I would do is look at the 10-year US and 10-year Germany. Russia is starting to recover in terms of the volatility is much lower in the ruble, and the 10-year yields went down to a level of 10 from like 15. They cut the rates. So these are things that I tend to look at.
Well, Udi, thank you so much for shedding light on this topic, and we look forward to discussing this with you again, especially as we come up into some of the summer markers that we should keep an eye on. On the Numerics video blog, it's our goal to examine the topics that you want to talk about, so please keep the conversation going on LinkedIn and on Twitter at NX Analytics. Thank you so much for joining, and thank you so much, Udi, for your insight.